All right, today we're going to talk about something huge. Literally. We're looking at how those massive skyscrapers that define our skylines actually get paid for. It's not like someone just writes one giant check. Nope. It's this really fascinating, layered financial structure that's all about balancing risk and reward for a whole bunch of different investors. Let's dive in. I mean, really, have you ever just stopped, looked up at some brand new, gleaming tower and thought, where on earth did the money for that come from? Well, it's a giant puzzle with different pieces of money from different investors, all with their own tolerance for risk, and it all comes together in a concept called the capital stack. So the key phrase here is the capital stack, and I absolutely love this analogy. Think of it like a Jenga tower. The blocks at the very bottom, they're solid, secure, not going anywhere. But the blocks at the tippy top? Yeah, they're wobbly, they're super risky, but man, they have the best view. That's the perfect way to picture how these deals are built, from the safest money at the foundation to the riskiest right at the very peak. Okay, so let's start where any good building project starts, at the foundation. In the world of the capital stack, this is called senior debt. This is the most fundamental, most important layer, and pretty much everything else gets built right on top of it.
This is the big one. It's typically a loan from a major bank or some other big financial institution. And honestly, if you've ever had a mortgage on a house, you're already halfway there to understanding this. It's the most secure, first-in-line loan, and it usually makes up the biggest chunk of the financing.
This table really tells the whole story. See that priority? It says first. That is the single most important word on this slide. It means these lenders get their money back before anyone else. You'll also see the LTV, that's loan to value, is pretty high, covering maybe 75% of the property's cost. But because their risk is the absolute lowest, their returns are also the most modest. We're talking in that 4 to 8% range. They're not trying to hit a home run. They just want a guaranteed base hit every single time. And this right here, this sums up their power position perfectly. When times are good, they get the very first slice of the profits. And if things go bad, if the whole project goes belly up, they have the first claim on the actual physical building. It is, without a doubt, the safest seat in the house. Okay, so senior debt covers, say, 75% of the project. But what about the rest? Where does that other 25% come from? Well, for that, we have to move up our Jenga tower into the middle. These are the hybrid layers, the ones that bridge the gap between that super safe debt and the much riskier equity. First up in the middle is something called mezzanine debt. The name mezzanine literally means that little intermediate floor you see between the main floors of a building. And that is exactly what this is. It's a second loan that sits right on top of the senior debt, and it's there to fill a really crucial funding gap. Now, look at the trade-off here. The priority is second. That means they only get paid after that big senior lender is completely paid back. So that's more risk, right? And what do they get for taking on that extra risk? Well, the returns jump a lot. We're talking double digits now. You're giving up a little safety for a much, much higher potential payday. Okay, now here's where things get a little weird, but in a really cool way. This next layer is called preferred equity. It's this fascinating hybrid because technically it's an ownership stake, that's the equity part, but it acts a whole lot like debt. It sits below all the loans, but it gets paid before the project's actual owners see a dime. So the magic words here are preferred return. These investors are basically promised a target return. Let's say it's 12 to 18%, and they get all the available cash until that target is hit. Only after they get their preferred share can that final layer of investors, the actual owners, start getting paid. It's a riskier spot for sure, but the return is super attractive because it gets prioritized. And here we are. We've climbed all the way to the top of the tower. We're at that wobbly, shaky Jenga block at the very peak of the stack. This, my friends, is the land of high-stakes risk and, if all goes well, incredibly high rewards. This is common equity. This is the developer's skin in the game. It's their own money plus capital from their partners, often private equity funds that are hungry for those big returns. They are absolutely positively last in line to get paid. But, and this is a huge but, if the project is a home run, they get to keep everything that's left. And that's the grand bargain right there. Priority? Last. Risk level? Highest. But those potential returns, they are completely uncapped. They call this the residual claimant, which is just a fancy way of saying you get all the leftovers after everyone else has been paid their fixed amount. The upside is, in theory, totally unlimited.
This quote just nails it. It perfectly captures the deal these investors make. First money lost, last money returned. If the project stumbles, their investment is the very first to get wiped out. But if it knocks it out of the park, they get the last, and often the biggest piece of the pot.
All right, so we've got the theory down, we see the structure, now let's see how this thing actually works in the real world. They call this the cash waterfall, and it's a great visual because the money literally flows from the top, filling each bucket one by one in order of priority all the way down to the bottom.
So let's pretend our building has a fantastic year. It kicks off $1 million in cash flow. Let's follow the money and see who gets paid.
Okay, first up, the senior debt holders get their $500,000 right off the top, no questions asked. Then the waterfall flows to the mezzanine lenders and they get their $150,000. Next up, the preferred equity investors get their $100,000 preferred return. And what's left over? A very nice $250,000, which flows all the way down to the bottom to the common equity holders. Everybody's happy. A great year.
This is it. This is the moment of truth. This is where the whole structure gets tested. What happens if it's a bad year? The economy tanks, a few tenants leave, and cash flow takes a hit. This is when priority isn't just a word, it's everything.
And wow, look at this. The difference is night and day. With only $600,000 in cash flow, senior debt still gets their full $500,000. They are completely protected. The remaining $100,000 flows down to the mezzanine lender, so they get paid, but they're short. And that's where the waterfall stops. The bucket's empty. Preferred equity and common equity, they get zero. Totally wiped out for the year. And that is the risk they signed up for.
So as we start to bring this all together, it really boils down to one of the most fundamental ideas in all of finance, not just real estate, the unbreakable link between risk and reward.
This chart just says it all, doesn't it? It perfectly sums up the entire concept. The lower you are in the stack, the safer your money is. The lower your potential return is going to be. But the higher you climb that stack, the more risk you take on, and the potential for reward just grows exponentially.
You know, in the end, the entire capital stack is just a spectrum between two basic ideas, credit and equity. Being a creditor, lending money, gets you fixed, predictable returns and protects you on the downside. Being an owner, having equity, gives you that unlimited upside, that lottery ticket potential, but it also means you carry the highest risk of losing everything. Every investor has to decide where on that spectrum they're comfortable playing. So I'll leave you with this question. Now that you've seen the whole structure, from the rock-solid foundation of senior debt all the way up to the risky, high-reward peak of common equity, just think about your own appetite for risk. Are you the kind of person who's building for security and stability, or are you shooting for the moon? Now that you know the rules of the stack, where would you place your bet?